Hey, what is going on, guys? Welcome back to another episode of Finance and Freedom. I'm your host. And today I want to talk about the third and final piece of this investing puzzle. The first two being stocks and index funds. And this last one is really important because it's something that I have been doing for over a year now, and has been a great way for me to grow my portfolio without having to worry about which stocks to pick. It's called an ETF, or an exchange-traded fund. So if you've never heard of these before, they can be a little bit confusing at first because the name itself doesn't really explain what it is. But we're going to break down exactly what it is, how it works, why you might want to consider buying them, and some examples of the ones that I've personally been buying. Alright, so let's start off with the basics. What even is an ETF? Well, ETF stands for Exchange Traded Fund, and as the name suggests, it's a type of investment that is bought and sold on an exchange like the New York Stock Exchange or NASDAQ. Now, when you buy a stock, you're buying a small piece of ownership in that company. For example, if Apple were to sell 100 pieces of pie to represent 100 shares of their company, and you were to buy one of those shares, that means you would own 1% of Apple. With ETFs, it's a little different because instead of buying a piece of a single company, you're buying a piece of a basket of securities. These baskets can include things like stocks, bonds, commodities, or even other ETFs. So just like with a stock, when you buy an ETF, you're buying a small piece of ownership in that fund. This makes ETFs a type of investment that is considered a mutual fund. Mutual funds pool money from multiple investors to invest in a variety of securities, which allows investors like you and me to diversify our investments with a single purchase. Now, there are two types of ETFs, but for simplicity's sake, we're only going to focus on the more common type, which is called a passive ETF. Passive ETFs track an index such as the S&P 500 or Dow Jones Industrial Average. By tracking an index, the goal of the ETF is to match the performance of that index. So if the S&P 500 goes up 10% in a given year, the goal is for the ETF that tracks the S&P 500 to also go up 10% in that same year. This makes passive ETFs a great option for investors who don't want to actively manage their investments. Instead, you simply buy the ETF, and then you hold it. That's why it's sometimes referred to as buy and hold investing. You don't have to worry about picking individual stocks or trying to time the market. The ETF will do the work for you by simply tracking whatever index that it's tracking. Now, there are some active ETFs out there that try to beat the market by having a manager actively make decisions about which stocks to buy and sell. But again, we're focusing on passive ETFs today, which are much more popular and easier to understand. All right, so here's a quick example to show you how this actually works. Let's say we wanted to invest in the S&P 500. Instead of trying to pick individual stocks to invest in, we could simply buy an ETF that tracks the S&P 500. For example, the Spider S&P 500 ETF. This ETF tracks the S&P 500 index, which is made up of 500 of the largest companies in the United States. So when we buy this ETF, what we're really buying is a small piece of all 500 companies that make up the S&P 500. And the nice thing is we get exposure to all of those 500 companies with just one single purchase. If one of those companies happens to be Apple, we get exposure to Apple without having to buy individual shares of Apple. And since the ETF is passively managed, we do and have to worry about whether or not Apple is a good investment or whether or not we're repaying too much for it. We just buy the ETF and then we hold it and let the ETF do the work for us. Alright, so that was a quick overview of what an ETF is. Now let's take a look at some of the benefits of investing in ETFs. One of the biggest benefits is that it's a very easy way to instantly diversify your portfolio. Like we talked about earlier, ETFs allow you to invest in a wide range of securities with a single purchase. For example, you could buy an ETF that tracks the S&P 500 and get exposure to 500 different companies with a single purchase. Another benefit of ETFs is that they're typically very low cost. Most ETFs have expense ratios of less than 1%, which means that they're a very affordable way to invest in a diversified portfolio. This makes them a great option for investors who are just getting started. Additionally, ETFs are also very liquid, which means that they can be easily bought and sold on the stock market. This makes them a great option for investors who need to access their money quickly. Finally, ETFs are also very transparent. Unlike mutual funds, which only provide updates on their holdings once per day, ETFs are updated in real time. This means that you always know exactly what you're invested in and how your investments are performing. So now that you understand some of the benefits of investing in ETFs, what are some examples of ETFs that you could actually buy? Well, there are ETFs that track just about any type of investment you can think of. Some examples include ETFs that track broad market indexes like the S&P 500 or Dow Jones Industrial Average, which, like I said before, are great options for investors who want to easily diversify their portfolio. There are also ETFs that track more specific indexes, such as ETFs that focus on certain sectors of the economy, such as technology or healthcare, or on certain investment strategies such as value investing or growth investing. You could even find ETFs that focus on specific countries or regions of the world, such as emerging markets. Personally, I've been buying 3 main ETFs. The first is the Vanguard Total Stock Market Index Fund ETF. This ETF covers the entire stock market. So by owning this ETF, I'm getting exposure to basically every publicly traded company in the United States. The second ETF that I've been buying is the Schwab US Dividend Equity ETF. This ETF focuses on companies that pay dividends. So by owning this ETF, I'm getting exposure to companies that have a history of paying dividends. The third ETF I've been buying is the Vanguard Total International Stock Index Fund ETF. This ETF covers the entire international stock market outside of the United States. So by owning this ETF, I'm getting exposure to basically every publicly traded company outside of the United States. Alright, so that's a quick overview of what an ETF is, some of the benefits of investing in ETFs, and some examples of ETFs that you could buy. Now you may be wondering how you can actually buy ETFs. Well, most online brokerages offer a wide range of ETFs that you can buy and sell. When you buy an ETF, you'll need to open a brokerage account and fund it with money. From there, you can simply buy the ETF, just like you would a stock. The great thing is that many brokerages offer commission-free trading on ETFs, which makes them an even more affordable investment option. Alright, well hopefully this video gave you some insight into what an ETF is and some of the benefits of investing in them. Remember, ETFs are a great way to instantly diversify your portfolio, save on costs, increase liquidity, and improve transparency. If you enjoyed this video, please hit the like button and subscribe for more finance and freedom. Thank you so much for watching, and until next time, I'll see you guys later.